Hi guys, welcome to Budgeting 101 by Finance Ways. Today we look at mutual funds. After all, you don't need to trade in stocks to grow your money. Let others do it for you smartly. To see an outline, we'll be seeing what are mutual funds, expense ratio, here I come, what are ETFs, indexes, and an activity at the end. So let's dive in. What are mutual funds? Firstly, they're simply a way to invest in many assets. A mutual fund is like a basket of investments, stocks, bonds, etc., managed by experts. But why? Why not put our money directly in stocks or rather than simple cash? Saving or cash is the equivalent of money slowly losing value. Stocks are risky and time consuming. Here comes mutual funds. You invest in investors, pros who do the heavy lifting for you. Basically, you give your money to professionals who invest your money and give you the return. That is the profit. Sounds too good to be true? Let's see the catch here. The catch is these professionals, also known as fund managers, investing for you aren't doing it for free. They take a small cut. This cut is known as expense ratio. So, what is expense ratio? Expense ratio is the price of convenience, the small percentage of your total investment that the fund houses charge to manage your money. It covers the fund manager's salary, marketing and admin, among other expenses. Remember, there are two types of funds: active funds, which are managed by professionals and, of course, have a higher expense ratio, and index funds or ETFs, which are passive and have super low expense ratios. Wait a minute, what was that term ETF I just mentioned? ETF or exchange traded fund is like a mutual fund, but it trades on the stock exchange just like a stock. Mutual funds are like playlists, not hand-picked songs, just the best of the charts. ETFs track something we call an index. What's an index? Let's see. An index is like a scoreboard for the entire stock market. It tracks the performance of a group of top companies, giving you a snapshot of how the overall market is doing. To take an example, in the United States, that you must have heard S&P 500 or Standard and Poor 500, which are the 500 biggest companies, including giants like Apple, Microsoft, Amazon, among others. In India, there's the Sensex or Nifty 50. Now your turn. After learning so much about mutual funds, indexes, ETFs, what would you invest in and why? Drop it down in the comments below. And which investment vehicle for your reference is something like mutual funds, stocks, bonds, etc. did you find the most interesting and why? Thank you for watching. This was Vedant Agarwal and this is Finance Ways.